All right, thanks for joining us, folks. This is a new series that we've started called Wealth Accelerator Online. This is to help and support our newsletter, which we do monthly. Figured there's always an opportunity to provide value. So we'll be mixing it up when it comes to different topics. Speaking, this will be once a month. I believe it'll be the first Wednesday of every month. So you may want to mark it on your calendar. Let us know if you find value of tonight's presentation. It is a webinar format. Feel free to just jump into the chat. Plan on making this a hopefully brief talk. Hasn't been rehearsed or anything, so I tend to be a little long-winded. So the goal tonight is really to give you a look of what we're seeing in the industry as it relates to market themes, inflation impact, and then also self-storage update, and then lastly, what we're doing as it relates to investment strategy and any adjustments. A few of our team attended the Inside Self-Storage conference a few weeks ago. My job is to keep a pulse on the market as it relates to conversations with brokers, with owners, with our lenders, and just anybody in the industry. I try, even though my background, I worked for the Federal Reserve for 20 plus years and was surrounded by economists. I try not to play economist. While there are some validity to numbers, there's always the devil in the details. So our job is to really parse through the data points, really aggregate what we're seeing and what we're hearing in the industry, what we're doing, and really respond to the market for what it's giving us, and not try to time or predict a market. So let's just jump in here real quick. All right, so major market themes, as it relates to stocks and crypto and the, indices out there, without looking at commodities, just some numbers to give you an idea of how things are performing for the year. The stock market, and this is based on the Dow Jones, down, without including, I pulled this number earlier this morning, so I know that Dow was down again today, down 9%. Crypto's been taking a beating, down 35%. Interest rates overall, and specifically, I'm talking about 5-year terms. This is primarily the debt that we take on for our investments. 5 years, about 1.6% higher on the year. 30 years, obviously much higher. Potential for a recession. We talked to, depending on where you read the headlines, first quarter GDP was down 1.4%. There's a lot of talk that was just strictly based on trade deficit. I'm of the opinion that we are closer to a recession, and this is based on talking to, just reading a lot of stories and articles from a lot smarter people than I am, that really study the markets. So there is a recession potential, whether it's starts in the coming quarter with another negative print or is towards the end of the year in the next year. The consensus does seem to be that with the rate of inflation and rising interest rates and the economy going in the wrong direction, that there is a potential for a recession over the next year. There's a big rush to sell real estate right now, and it's slowed down a little bit recently. I was talking to one of the brokers that we work with a lot earlier today, and there was, when the interest rates spiked over the last few months, there was a kind of a pause taken in the industry as it relates to acquisitions. They're seeing some adjustments on pricing. We're selling one of our self-storage deals right now just to take advantage of still that there's a really good positive market for exits right now, and really to capitalize on the increase in especially self-storage over the last year. We've got a lot of friends that are in multifamily, other asset classes that are really monitoring. A lot of folks are still buying. REITs, although paused, are back to buying right now. Little tighter underwriting, which we'll talk about. But overall, it still is a relatively strong seller's market. Self-storage is responding well to all of we've done really well as it relates to inflation and market rents over certainly this year, but also over the last year. I mean, we've increased rates easily 15% plus per store this past year, or this year alone. We've been really aggressive on pricing. Another big theme that we've heard from the brokers is the days of 20+% IRR returns on investments. Those days are about over. Investors should adjust based on higher cap rates that will eventually make their way. Minor blips right now that we're seeing, but overall, return expectations need to be tempered. We've had a really strong run over the last few years. We expect that to at least slow down a bit. So if we were looking at 20% IRRs for investment deals, we're looking at 15 is really some good numbers. Now, obviously, we're biased when it comes to real estate and self-storage, but we really believe that there's still no better place to invest your dollars. We're actually in the process, and I'll touch on it at the end. We're in the process of doing a market sentiment survey. So I'll have a link at the end. If you haven't already filled that out, please fill it out. We want to hear what you're also hearing out there. You obviously are active investors yourselves. So we're going to compile that data just from the people that we know and are connected to, and this will really give us an insight into the appetite. All right, inflation. So there's no secret that food, gas, and energy are spiking across the board. You only need to go to the gas station, the supermarket, or see your utility bills to understand that. Some numbers of what we're seeing so far this year, and take these numbers with a grain of salt. These are national averages. 9.4% in food, 43% gas, and 30% in energy. I never thought that I'd see such high gas prices, but here we are. I'm also looking at this from a global standpoint. There's lots of talk of food shortages, whether it's fertilizer, whether it's wheat, whether it's countries that are limiting exports, something to keep an eye on. Obviously, supply demand, as countries make different decisions, there's a downstream impact. What does that have to do with real estate and self-storage? Is when you start to erode household income, there's naturally an impact as it relates to people's ability to be able to afford housing, rent, certainly when it comes to storing goods, paying premium prices. So less of a factor, at least for us now. I mean, it's the geopolitical turmoil, war in Ukraine. There's a lot of, pointing fingers of the impact there. A lot of that is just grabbing headlines and looking for things to blame. My personal view is that there's certainly some impact, but the geopolitical turmoil that we're seeing is less impactful to what we're seeing for real estate and self-storage as it is relative to inflation, imports, and exports. On the self-storage side, net rentals year to date are strong. I looked at our performance across our properties, positive net rentals every single month. It's good for us. We're hovering across all of our properties, generally speaking, 93% in terms of occupancy. We obviously want some turnover to get some of the more price conscious and older tenants out and some newer tenants in, paying the higher street prices. But overall, we're not seeing any slowdown. Rent increases are being absorbed. Funny story, at one of our properties, we had cut over our storage software, and we sent out rent increases prior to the conversion. And then when we converted, we had a little bit of a hiccup where they got sent out another rent increase. So we had some tenants that got hit with 15% increases over this 15% increases over the span of a couple months. We had some fallout, but not what you might expect from a 30% increase. So they are absorbing the increases. How long that is going to continue is anyone's guess. We are adjusting our expectation that that's not going to continue for the foreseeable future. Historically, 3 to 5% annual increases are what's normal. Last year or so, we've been seeing 15% easy across the board. We started slower in increasing rents and then have been more and more aggressive just to try and push the envelope. And we're still being able to, it's still being absorbed. Our underwriting is being adjusted, though, to account for that not being the case in the future. Demand is still really high. New supply is not as aggressive as it was prior to even COVID. We know that there's supply chain issues. We know that the cost of construction has gone up. When it comes to self-storage and development and self-storage, we're talking a lot of concrete, sheet metal. So we haven't been as subjected to the supply chain and inflation pressures in construction. But there has been a slowdown. We're not nearly seeing as much new supply coming on, especially in major metros. All right. So as it relates to Hearthfire Capital and our strategy adjustments, whether you're see a number of folks that are invested in our deals or considering it, basically we're underwriting. Our underwriting is getting a lot tighter, and we're underwriting for higher interest rates. I spoke to 2 of our lenders today, and if you ever want to just have a cheat sheet as it relates to what the current rates are, just look at the given 5, 10, 30-year treasury yield, add 1.5 to 2% on top of that. It gives you, generally speaking, what you should expect for interest rates for mortgages. The lenders that I talked to today are at 4.25 to 4.5% to 4.4 to 4.75%. We are underwriting higher than that. The expectation is that the Fed is going to raise rates over the next at least 1, if not 2 meetings. I expect that they're going to go to the next one. We'll see an even greater slowdown. Maybe they'll get to 2 more rate increases till things start slowing down. Now, we don't tie directly to Fed funds rate to interest rates when it comes to debt. However, there's a downstream impact that usually indicates, treasury yields will bounce. So we're underwriting higher interest rates, 5.5%, and doing sensitivity analysis. I'll touch on that in a minute. Loan to value, historically or recently, we've been at anywhere between 70-75% loan to value. We're now underwriting 65%. Our lenders are not showing that they are, adjusting or looking for lower debt to, or LTVs, but we are underwriting anyway. Our pace of rent increases, if we were underwriting in year 1, year 2, that we were going to be increasing rents 8-10%, we're adjusting them 2-3% lower. And a lot of this is factored into, the market, the premium as it relates to competition. So we're adjusting our pace of rent increases. And as we go further out into the years of our holdings, then we're, naturally being a little bit less aggressive in terms of, looking at what are normal rate increases. Higher exit cap rates. So where cap rates have been, I'm speaking primarily from self-storage. They've been a little lower depending on the asset class and depending on the class of property. But we're for what the markets, property types that we're looking at, we're adjusting our exit cap rates and going in cap rates for that matter as well, 25 to 50 basis points. That's what the industry is seeing right now in terms of properties being traded. So if they were trading at 5% cap rate. Maybe they're at 5.25, maybe they're at 5.5, depending on the quality of the asset, depending on the value add proposition, so on and so forth. So we're adjusting for higher cap rates across the board. We'll continue to adjust that and really keep an eye on things as we hear what is going on in the markets. Lower supply and higher demand. When we're looking at different markets, in case you're not aware, the equilibrium number for per capita supply and demand is about 8 square foot per capita. We like being in markets where there's much higher demand than there is supply. We're adjusting our underwriting to where we might be looking at a property that's 6-7 square foot per capita. Maybe we'll look to 5-6 just to adjust some of those numbers, just to add a little bit more sensitivity to our risk analysis. So recession risk and sensitivity analysis. This is what we are looking at. Employment industries. So when we're going in the markets, we're looking at who are the employers. We're looking at the employer diversity. Obviously, we don't want to buy in markets where there is highly concentrated, 1 or 2 or 3 employers. We want a good diversity of employers. We're also evaluating the industries that they're in and really being a little bit more selective and looking at what might be impacted should there be a recession. Population density and trends. Historically, we're looking at markets that have at least maybe a 10,000 people population in 1 and 3 miles. We're going to increase that a little bit where necessary. We're looking at population migration as well. Again, we like to invest in secondary and tertiary markets, so I'll talk about that in a minute. And then obviously median income. Historically, we've looked at markets that are $50,000 a year or more as median income. Anything lower is generally more of a poorer market. We don't like to be in markets that have a lower threshold. So 50, we're adjusting that to at least 55, maybe $60,000 a year, and that should account for some increase in income as well. We are going to continue to pursue secondary, tertiary markets. Right now, we're in Pennsylvania, Indiana, and Illinois. We like those markets as much as we'd like to be in some of those Sunbelt markets. We're really, they're highly competitive, trading at high premiums. We like to be in more of the sleeper markets that are, maybe triples versus home runs with some downside risk. We are being more selective on market properties. There's been some really aggressive, properties that are listed in terms of trading based on trailing 3 months, and the pro formas are ultra aggressive. We're maintaining open communication with the brokers just to understand what they're seeing, what they're about to put on the market, evaluating those deals, and really being sensitive to those deals that are being put out the market because of somebody just looking to capitalize, and really trying not to buy the value add baked right in. Low risk value add. In some cases, we are still looking at properties that have management upside, but where there's not management upside, believe it or not, some of the expansion plays that we look at there, we consider them lower risk just because, we're buying properties that have by right ability to expand, and there's abundant excess demand for us to be able to support those expansions. We love finding those management plays, but we're not seeing a whole lot of them right now. So our wheelhouse right now has been a lot of expansion plays. versus a lot of what historically we've been looking at, just management and operation efficiencies or optimization. I mentioned the expansion potential. That's still something that we really enjoy, taking a property that may be 30,000 net rentable square feet and turning it into 50, 60,000 plus. All right, some new opportunities. So it was interesting at the conference, talking to a number of people in the industry, including developers. So one of the areas that we kind of landed on is talking to some brokers, is when you're talking about properties that are trading at, in some cases, 2x the amount that it would take to build something. It doesn't make sense. To give you an example, a lot of properties are trading at $150 plus per square feet. We can build at 80, 85, including soft costs. So in some cases, depending on, the location, the demographic, supply demand analysis, we can build in equity at C of O. So we are looking at construction opportunities in underserved markets. We've got a really strong team of developers that we're working with that are working on our existing facilities. They're strong both in terms of land development as well as on the construction side. We've got our in-house construction team as well. So we are actively looking at new construction in these underserved markets. A really hot topic was RV and boat storage at the conference. And this is dedicated storage where it's covered parking. You're talking about concrete or asphalt lot, covered parking, maybe some solar to provide some trickle charges for RV. The RV industry was booming, and I know we have an RV rental business that literally we started during the early parts of COVID, just because we bought an RV for our family and saw the explosion in the number of RVs that were being sold. There are millions. I mean, the folks in Indiana, where most of these things are made, they can't keep up with the demand. We're very connected with a local large RV dealer, and there's a lot of units. We're talking about hundreds of thousands that have been sold and are continue to be sold. And if you're not in the RV industry or have or know anybody, these things, you can't just park them in front of your house. In most cases, there are ordinances, municipal regulations in terms of how you can store them. So there's a huge demand for RV and boat storage. I attended a number of presentations at the conference. During the development workshop, it was a topic that just kept coming up during a regular self-storage development talk. And then I also toured an RV and boat storage facility that was literally out in the middle of nowhere. The interesting thing about these properties is they're generally situated in between where people live and popular recreation areas. The facility that we toured was literally in the middle of the desert in Nevada. Blew my mind that somebody would actually, it's a road with tumbleweeds flying by, and there have RV and boat storage. The big parts of this play is that there is significant demand. The opportunity lies in the fact that there's not a whole lot of data in terms of supply and demand. We see that as an opportunity. The more data that's out there, the more people that obviously flock to it, just leverage the data and do whatever they're going to do with it. There's also a land bank play with it, meaning that you're talking about not a whole lot of infrastructure to build. So there's always the opportunity, if things go well and the facilities are located properly, that you can look to redevelop it down the road. So this is an area we don't have any opportunities right now in this space. It's part of our survey to just gauge who else is interested. But we know that there's significant demand out there in the industry, and the numbers are pretty lucrative. We are looking at JV opportunities. So interesting, as we've been making our rounds, whether it's on podcasts, people that have invested with us, like our platform, like what we're doing, like our capabilities when it comes to asset management, property management, and in some cases, even self-storage owners, where they're looking for opportunities to not just cash out on a property, but how to save money on taxes, how to, what to do with the sale proceeds. So there are JV opportunities. We don't have anything in the pipeline now. If you're in the industry and you come across a property looking for a partner, that's something that we're going to be considering as well. All right, that's almost, exactly 30 minutes. That's the prepared presentation that I have. Hopefully you found this useful. Didn't want to get deep into the statistics. There is the link there for the survey that I mentioned, hfire.co, and that is co/survey. And then our first live event, just want to give you some idea to save the date, August 16th to 18th. This is going to be an immersive experience where we're also going to be touring some of our self-storage properties. It's great for our investors. It gets hands-on view and first look at our properties.